Future PLC has just released news that could put a floor under the share price, which has fallen by over 80% since August 2021. But in the short term, there's a key area on the chart worth paying attention to, and it determines whether it's going into a new uptrend or it's resuming the downtrend. Okay, let's take a look. So before we start, Future, what do they do if you don't know? Okay, so essentially they were a traditional media print business, like magazines, all that stuff. But that wasn't going well. So under the tenure of the CEO, then was Zila Bing Thorne, transformed it into a digital media platform. All right. Now, here are some of the brands, about 250 brands they have. And some of them are Tom's Guide, Smart Brief, Marie Claire, Country Life, Tech Radar, PC Gamer, Sun and Blend, Homes and Garden Space, Go Compare, Wallpaper, and it carries on. 250 of them is in well-defined areas, okay? And this is where they sit in the market pretty much. So in the UK and US, that's where they're pretty much based, and they share this content. And they are expanding more towards the US, but currently about 60% of the revenue is UK based. But the new CEO is from the US and started a digital media business there, very successful. And we'll get into that in a bit, and that will help the push out there. But if you look, there's sort of four sort of verticals here: tech, homes, women's wealth. That's the sectors they operate in because they're monetizing and they have sort of loyal audiences. But in the UK, number one, and the US in tech. In homes, they're number one in the UK, number four in the US. Women's fashion and beauty, 4 in the UK, 7 in the US, and wealth, 36 in the UK and 24 in the US. And they say its content is read by 1 in 3 adults in the US and UK. And that's how much their brands penetrate the public. All right. And you can see the progression they've had there, like a stock market star. This was, I'll show you the chart in a bit. But as you can see from this is half year, by the way, because the last set of results were half year, and this is from the presentation they've done. 2016, you see compound annual growth in revenue of 45%, operating profit 107%, adjusted EPS 61%, and free cash flow 87% compound growth. So very impressive figures. If you notice, you've got literally the revenue year tailing off. It's not growing. The first year, this revenue and everything hasn't grown, you know. Where do they make the money specifically? Roughly a third of its revenue from advertising, a third from subscriptions, and a third directly from readers to e-commerce partners or affiliates, of course. People click through and buy stuff, of course, they're recommended the magazines. It's a very good relationship with them, the e-commerce partners, pretty much. So the news that came out that I think is quite significant, and it's never been done before, return of cash to shareholders via share buyback, okay? Like I said, historically, they prioritize organic and inorganic investment before debt repayment, returning excess cash to shareholders. They say now they've strong balance sheet. However, the board believes the share buyback program will provide greater flexibility to achieve an optimal use of cash to deliver for shareholders. So basically, that's in big text there, if you want to read that. So 45 million, but they have authorized the company to buy back up to 10% of its existing share capital. 45 million is around about 5%, but they are looking for permissions up to 10%, okay? So it could get bigger. Why do companies buy back shares? Worth looking at this, essentially, okay? So one of the reasons is they consider their stock to be undervalued. Like I said, the best way to return value to investors is start buying up stock. So they buy shares and cancel them. It reduces the shares in issue. So there's the opposite effect of issue of equity. And we're all used to having issues of equity. That's more common, especially if you're an investor in smaller or micro cap companies that are loss making, and so they issue equity to raise funds, of course. But that again makes the market capitalization bigger in a company, and valuation metrics go down. But the reduction of shares when they buy back means a smaller market capitalization, which means valuations become more attractive. An example: if a company earns 100 million in profit and have a market cap of 1,000 million or a billion, that's then a PE of 10, okay? Earnings go into the price 10 times, okay? If you earn, say, 100 million profit and have a market cap of 900 million, and that goes down, all of a sudden it gets cheaper as a company, okay? It also has the effect of a big buyer entering the market. Remember, they're going into the market to do this. And so if you look at the average daily volume in Future, and this is volume normally over 30 days, added up, divided by 30, it's about 700,000 shares. At £8 a share, that's about £5.6 million. So if roughly half of that is buys, which normally is, if the share price is going sideways, then normally it's roughly half-half. If the share price is going down, then you can assume there's net sellers. But let's just say half is buys, okay? Then that would be 16 times the average buy volume. Now, if less had been buys because more people are selling, of course, that'd be more than that. So what you get here is an effect of not only adjusting the market cap so the valuations look better, but also in the market, liquidity starts to get weighed to the buy side. Right? You get a lot more buying coming in. And so if there are any shorts in this company, they may stop, close, or buy the shares up because a big buyer is coming in. And that could burn them if they're short in the stock. They also have a resolution authorizing the company to buy back up to 10% of the stock. So that would be around about 96 million at £8. That's double the 45 million. Let's just talk about the story so far, okay? So originally, Zilla Bing Thorne took the reins of Future in 2014. It was riddled with debt and on the brink of collapse, 13 million. The magazine queen, as she's been dubbed, has since transformed the publisher into a 2.2 billion empire of 250 titles, including everything from Country Life, Marie Claire. It's not 2.2 at the moment, of course, because the share price has fallen. It's about sort of close to a billion. Shares have soared over 1,000% on a watch, and in fact, more than that actually, because I'll look at the chart here. Since 2016, they've done £1 a share, and they go close to 39 quid by mid 2021. That's 3,000%. Okay. Now, Zilla Bing steps down, and this was announced back in 2022, but it actually happened in 2023. So Steinberg, a former BuzzFeed Daily Mail executive, will replace Bing Thorne in April after she spent 9 years transforming the publisher of Marie Claire and The Week into digital success story. So you can see he's got some big shoes to fill. Then the global slowdown happened, and as you can see, to be honest, this new CEO John only came in when it's pretty much fallen off a cliff here, because what happens when a slowdown in the global economy or the recession's on the horizon, the people are worrying about a recession, people tend to tighten their budgets, and advertising budget, spend budget, and that is one of the first to go, because if people are not going to spend, there's no way advertising to people who are not going to spend. So that takes a hit, but 80% hit, because that's how much the share price is down. Is it overdone? Well, let's have a look. So let's look at the new CEO. And I've got to say, I quite like him. I watched the presentation, and he's very successful, and he has got passion, and he's very gutsy. But he's appointed on the 4th of April, not 2026. That's a typing error. He wasn't appointed in the future, ironically. But John was the president of Altis USA's news and advertising division. So advertising focused monetization, which encompasses News 24 or 12, I24 News, Cheddar News, and Altis USA's A4 advertising unit. Altis is the 4th largest cable provider in the US. But the interesting story here is that John joined Altis through the sale of Cheddar News, a digital-first innovative news company which he founded in 2016. Prior to Cheddar, he was a CEO of DailyMail.com in North America, where he grew revenues by 45%, having joined from BuzzFeed, where he was president and COO. So very hot digital properties, Cheddar. And then it's worth noting that on the 19th of May, just after a trading update, when the shares dropped, he bought over 90,000 shares at £8.86. The share price is now below that, but that cost him £802,000. So where did you get the money from? Let's go back to Cheddar. Okay, he buys stock here, the share price goes down. Cheddar acquired by cable operator Altis USA for 200 million. John started this, founded this. He raised about 10 million, I think total of 54 million altogether, and sold it for 200 million, which is a good return. And so I don't know how much I try to find out how much he owned of that, but if it's 10%, then he's made 20 million. 5%, 10 million. 20%, 40 million. So either way, even if it's 5%, he's worth about 10 million. But I've seen estimates that he's worth a lot more than that. Okay. And very clever, actually, because the way he started Cheddar, he was seeing how CNBC and television shows like this were getting a bigger bang for their buck because they were live. And you realize not only do you attract more bucks in advertising because it's live, but there's less production time needed. Because, of course, if you're producing stuff that's not live, it has to be edited, sent off. There's people involved in that, comes back, takes time. And he said there's something a lot more exciting about live news where you can reflect things going on there and then. But anyway, if you look at this, 3-year-old, that's all it was. He sold it for 200 million. John said Cheddar, which had raised a total of 54 million in funding. Other investors included Amazon, AT&T, Comcast Ventures, Rain Ventures, Liberty Global, Goldman Sachs, the New York Stock Exchange, Lorne Michaels Broadway Video, and Lightspeed Venture Partners. So he's a very clever guy who raised a lot of money for this company and a very successful exit, And it's worth watching some videos on him. Just Google him. He's a very sharp fella, and I think he's a good pick for Future PLC. So let's just have a quick look at the spreadsheet of Future, okay? Now, this is the last set of results, 6 months. This is 12 months previous to that. Like I said, we are market cap pretty much of 900 million, 922. Enterprise values of 1.3 billion. What does that mean? Well, they've got debt. That means if that's higher than that. A net asset value of 1 billion. So we are below net asset value right now. The average daily volume, 5.2 million, pretty much, like I said earlier. Revenue for the half year, 404 million. Operating profit and loss, 83 or 84 million. Cash of 30.8 million. Debt, 421. So that's a bit of a red flag there. But nevertheless, they are generating, cash. Now, free cash flow will be higher this year, I believe, because they normally acquire companies on a regular basis. The last set of companies that they acquired cost 55 million. Last two sets of companies they bought, so that could be higher. But of course, now they're going to use that to return to capital to buy shares. So let's look at the growth. We know the growth hasn't been very good here. It's been flat pretty much top line, and everything else has gone down. Okay, we can see that down. Free cash flow is down 63%, but largely it was down to investing and acquiring companies. Value is great, and that's the point. Right now, prices of 1.14, price to earnings 8. That's all it's at. Okay, and that's on a slower sort of earnings profit, because that's gone down a little bit this year. So it's less than that. But that multiple traditionally has been up at 25, 30, higher than that. And now it's at 8. Price to book, I said it's below net assets. That's very good. EBITDA 5. And free cash flow 12. I said health is a bit questionable. They've got an increase in cash for the half year, but they are in a net debt position of 390,000. So how much is that? How much is the total debt of the operating profit? With 2.5 times or 2.5 years of operating profit covers their debt, so it's not that big a problem. And if they can be more efficient, maybe they'll be even less. Current ratio is fine. Quick ratio is a very high bar to get over. Efficiency is very good. There's no gross margins in their financial statements, but the operating margins 20% and pretty much 14% for net margin. That's down, like I said, due to acquisitions. Return on capital employed is 10%, it's very good, and 11% there. And the forecast, I said 118% for next year, 121, 126. So top marks for that. Okay. Let's have a look at broker targets. They've got 10 analysts covering the stock. The average is £15.73 a share. The maximum is 23.84. There's one down here. I don't know where that. Maybe it's an old analyst report, but generally the average is double where we're at. Okay. Now, in summary, this is my thoughts. In the short term, you've got to look as the downtrend ended. So let's go to the chart, okay? Because these are very key levels, and there are some fake breaks here. It's happened before, so you've got to be careful to make sure you are in a trend that's playing out. I mean, look at this there. So this is a 200-day moving average. This is a 50-day, what's called a death cross here, where that 50-day cross down over there starts falling. Okay, and it doesn't. It pretty much it does breach the 50-day, doesn't get anywhere near 200. And down here at 16 quid, it breaks 200, and that looks good, but all of a sudden breaks down again. So you've got to be careful. There are fake breaks here. Even this one, as you see, it rose up and down here, broke above it pretty much. This then came back in this sort of trend line and couldn't quite, I don't know why I've got that there, couldn't quite manage to get above it here or there. And all of a sudden it broke down on this lower, in fact, I had shares here that I sold once it broke this previous support, because it hit it once there, twice, 3 times, and then it touched again here and it broke down below. And then a trading update, it gapped down. And then the CEO, I think, bought some shares here at 80 odd, I think, the new CEO, John. And now this is where we're at. So this is quite key. They announced, I'm going to fatten this out. They announced a share buyback program. I think it was here, is it 7th or 10th? 10th it was, yeah. And it sort of gapped up here, which is very odd, the day before. And then since then, it's broken up above higher and touched the 50-day moving average. So, as you can see here, previous highs, okay, and it's gone above that. That's a good sign, pretty much, because now you've got another level here of, support, resistance. There's going to be previous resistance and now support. So I would say if it breaks down below this, which is around about 732, it may resume the downtrend. If it stays above this, if we go sideways and up, we're going to start a new uptrend. I mean, there was a big sell-off in some stocks on Friday, so maybe that's where it is. Maybe we'll see a bounce here, but I would be wary of holding the stock below 730, so it may go back into a downtrend. But nevertheless, mid to long term, the question is, can John succeed? I believe he can. He's a very clever entrepreneur. And if you just read his backstory, he's innovated in the digital media space, and he also has come at it from that, monetization, advertising point of view. So he's a lot of experience and he gets things done. So wherever the share price settles in the short term, keep an eye on Future PLC, because I think John Steinberg could be the second sort of coming, second magazine queen. I'm sure he wouldn't want to call that. Maybe the magazine king or digital king for Future. So I hope that helps. Please do your own research.